Hello everyone and welcome back to the world of finance. Now this video is designed specifically for CFA Level 2 candidates who are preparing for the subject derivatives. Now within derivative subjects at level 2 there are just two chapters. One is the valuation of forward commitments and the second one is valuation of contingent claims. So when I look into the students' doubts and when students struggle to understand certain things, chapter 2, that is valuation of contingent claims, it is all about option valuation basically. When we say valuation of contingent claims, options are generally defined as contingent claims. So valuation of options, what all you have in your curriculum. At level 1 you had 1 period binomial option valuation model. Now you have 2 period binomial option valuation model. It's not that 1 period is irrelevant for you. 1 period binomial option valuation model can still be tested at level 2. But primarily you have moved from 1 period to 2 period when you come to level 2, and the transition from binomial model from 1 period to 2 period, then 2 period to multiple periods, and then leading it to Black-Scholes-Merton model. That is the beauty of the whole option valuation, because in reality today worldwide the option valuation model that works everywhere is BSM, Black-Scholes-Merton model of option valuation. So let me take you to this part. So in this class we are going to discuss Black-Scholes-Merton model from its very scratch, from the core, from the initial fundamental aspect. So Black-Scholes-Merton model, in short you can call it BSM model, and here in this class we are learning the transition from binomial model to BSM model. So this transition is very beautiful. What I'll do is I will get started with an example where that example will target the option valuation, the valuation of call and put through binomial model. It will be a 1 period binomial model. When we construct the whole process of delta hedging, and through that we gradually develop the logic of shifting to Black-Scholes-Merton model, that transition is beautiful and that is worth understanding. So I want you to carefully look into this example which I have placed as a test question. So ideally what a level 2 candidate should do is, when I display that example question, you should not wait for me to solve. I am definitely going to solve that, but what you should do is you should not even let me read that question. If you are really a sincere candidate, you should take it up that question as a test question. So what ideally you should do, you should pause the video, solve that example, and then resume the video to look into whether you are really able to handle it fully on your own. Even if it takes time, it's worth doing that, so that when I'm showing you the solution you can identify whether your approach was correct or not. But yes, you do everything as a rough work. The presentation that I'll show over here is going to be extremely important, because many students, because of little laziness, they don't tend to write everything, because they know that we are going to face MCQs and we don't have to write so much. But if this is going to be a note for you through which you are going to revise everything, my suggestion is every time I show you something on screen, I'll just give you time to take the screenshot, and you can utilize the time, take the screenshot. Later on you can write everything systematically in your notebook. That helps a lot for revision. Many level 2 candidates, when they come to me during exam time, they come up with one thing, that they are not able to recollect everything what they have learnt in class, and recollection will become very, very powerful when you have written everything in your own notebook, in your own handwriting. That's better. So let's begin with that test question. And as I said, the moment I display this test question, you should pause the video, then attempt solving this question, and then resume the video. I believe you did what I have instructed. You have attempted this question on your own. Now let me read it out for you. A stock is currently trading at $160. Over the next period, the stock price is expected to either increase to $200 or decrease to $120. A European call option and European put option, both with a strike price of $180 and a maturity of 1 year, are written on this stock. The risk-free rate of interest for the period is 5%. You are required to determine the probabilities of the price moving up or down. So basically, when you are determining probabilities through this data, it is implied that these will be risk neutral probabilities. Then the question is asking you determine the value of call and put options today, calculate the hedge ratio or delta for the option, show the significance and application of hedge ratio. So once we solve this question, we will be gradually moving from the binomial model to Black-Scholes-Merton model. So let us look into what we have to attempt first. The single period binomial option valuation model, it starts with the spot price at present, that is $160. The up move will be up to $200 by end of the period, and the down move will be up to $120 by end of the period. So look at one thing. What was the exercise price of the call and put option? The exercise price of the call and put option in this case was $180. So if you are talking about call will be exercised whenever the market price is greater than the exercise price or strike price. So strike price for call was $180, and at this node the market price is $200. So definitely call becomes exercisable at this price, and the value of the call will be 200 minus 180, that will be $20, because the option will be exercised. What happens at this node when you are talking about the put? A put option is exercisable only when the market price is less than the strike price. Here the market price has gone to above the strike price. So put option will not be exercised, and when option not exercised, its value will be 0. So we are talking about this particular node where the value of call is $20 and value of put is 0. What happens at a price of $120? Here the call becomes out of the money and call will not be exercised, but put will be in the money and put will be exercised. The value of the put over here will be the strike price minus the market price. Strike price was $180 and the market price is $120. The market price what we are referring to over here is not the actual market price, of course. This is the expectation, correct? Because this is the result of the up move and down move. Now we know one thing, that in binomial model the risk-free rate, which is 5%, the factor for the risk-free investment will become 1.05, symbolized as capital I. So 1.05 is the factor for the risk-free investment. In simple words, if you invest $1 at a risk-free rate of 5% for the period, by end of the period $1 will become $1.05. Now we have to also find the up move and down move. The factor for up move will be the higher probable price, which can be also symbolized as SU, that is spot price when the price goes up. So SU divided by S0 or HPP divided by S0, that up move will give you the factor of 1.25. What will be the down move factor? It will be SD, that is the spot price when the price goes down, that is $120 divided by $160. So it can be written as a lower probable price divided by S0 or SD divided by S0, that will be 120 divided by 160. The down move comes to 0.75. Now, the probability of rise in price, the risk neutral probability of rise in price, which you have learned earlier in all previous topics, that is I minus d by u minus d, and that when you calculate, it comes to exactly 0.3 by 0.5. Let me enhance the screen size for your reference. So the probability of rise is 0.60. The probability of fall will be 1 minus the probability of rise, because there are only two possible outcomes. So we are taking 0.6 as the probability of rise and 0.4 as the probability of fall. So you can take the screenshot over here and then I take you ahead. Alright friends, once you have taken the screenshot of this or taken the note of this, let me remind you once again, the probabilities that you are determining over here by taking this approach, this is basically the determination of risk neutral probabilities. So these are not actual probabilities, these represent the risk neutral probabilities of up move and down move. So if I just give you a note on that, the 60% or 0.60 what you computed is not necessarily the actual probability. Maybe the actual probability exactly matches with that, we don't know. But what you are determining, you should consciously be aware of that. This is representing the risk neutral probability, and that the probability indicates that the probability of rise in the price. This is the risk neutral probability used for valuation. The model behaves as though investors are risk neutral. So model behaves as though investors are risk neutral. So an evidence of that simply can be identified this way. Imagine the rise in price, correct, the SU, the higher probable price when multiplied to the probability of rise in price. So $200 multiplied to 0.60, and SD, that is the lower probable price multiplied to the probability of fall in price. So 120 into 0.4 plus 200 into 0.6. In simple words, you are taking the weighted average of these two probable prices, correct? And what are weights? Weights are the probabilities. Which probabilities? Risk neutral probabilities of price moving up and price moving down. So the result is the expected value is coming to 168. Now, if $160 was invested at risk-free rate, the risk-free rate being 5%, $160 at the beginning of the period would have become $168. That is why we are saying that these probabilities represent the risk neutral probabilities. So I'm sure you have taken note of this already. Let us move ahead, and now we will say the value of call C0 will be Cu into probability of price moving up. Cu, that is value of call when the price goes up, we have already determined that as $20, plus this part is 0 because the probability of moving down was 0.4, but the value of call when the price goes down is 0, so we have made this entire term as 0, and divided by the factor for risk free investment, that was 1.05. so the value of call at present will be 12 divided by 1.05, which comes to $11.4286. so value of call option $11.4286. When you similarly go for computation of the put option value P0, it will be the value of put when the price goes up into probability of up move, which will be 0 because the value of put itself is 0, but the value of put when the price goes down multiplied to the probability of price moving down, so 60 into 0.4, that will be the value by the end of the period, and dividing it by the risk free investment factor, it will give you the present value of the put, which is P0. So 24 divided by 1.05, 22.8571, that is the value of put at present. So we got the value of put option as $22.8571. Now this was one part of the solution. Next is about the delta of the option. So as we know, delta of call can be computed by taking CU minus CD divided by SU minus SD. What is CU? CU is the value of call when the price goes up, that is 20, and CD is the value of call when the price goes down, that is 0. And SU and SD we have already defined initially, these were 200 and 120. So if you take the computation of delta, it will be 20 minus 0 divided by 200 minus 120, that will be 20 divided by 80, which gives you 0.25. So 0.25 is the call delta that indicates number of shares required to neutralize risk of one option. Now recollect from your earlier learning what is the meaning of this line, and if you are not able to recollect, definitely I'll help you understand that once again. Alright friends, so let me take you to the deeper part of this delta. If you recollect, in the earlier classes when we have learnt option valuation, the option valuation was learned through various models, and one of the easiest way was applying the simplified version of portfolio replication model. Within the steps applied in portfolio replication model, one of the step was take a ratio of spread in share price divided by spread in option value. Spread in share price, that is SU minus SD, that became the numerator. 200 minus 120, that will be 80, and 20 minus 0, the spread in the call value, becomes the denominator. So it will be 80 divided by 20 in that case. It will be reciprocal of this ratio. That would indicate 4. 80 divided by 20 is 4. What does that 4 signify? That signifies that you will need 4 call options against each share. So when you transform this logic to delta hedging, imagine if you need 4 call options against one share, how many shares will you need against each call option? The answer is 0.25, that is 1 by 4. So if it is 4 call option against each share, there will be 1 by 4 share against each call option. So what happens when you write a call? Understand the point. When you write a call, you create a big risk for yourself, correct? So after writing the call, when you sense that high degree of risk, you would want to hedge that risk. So simply what you should do, against each call option that you have written, you should buy delta shares. That means in this example, you should buy 0.25 share for every one call option that you have written. If you do that, your portfolio is hedged. That is the primary logic of delta hedging. Now, I want you to carefully note the later part about delta. So look at this. For the call, delta is CU minus CD divided by SU minus SD. We have already computed this delta, that is 0.25. So for the put, you can compute the delta, that is delta of put, by taking PU minus PD divided by SU minus SD. Look at one thing, the value of put when the price goes up was 0, value of put when the price goes down was 60. So 0 minus 60 will give you negative 60 divided by 80, correct? So negative 60 divided by 80 will give you negative 0.75. So what is the meaning of this? For the call delta being 0.25, it means buying one call gives stock like exposure equivalent to buying 0.25 shares, and put delta being negative 0.75, buying one put gives exposure equivalent to shorting 0.75 shares. And we know one thing, the connection between the call delta and put delta, connection between call delta and put delta, it is simply delta P equals to delta C minus 1. So delta P is dependent on the delta C value. If you are not computing this directly, you can simply find out that delta P can be computed by taking delta C, that is 0.25 minus 1, which will give you 0.75 with a negative sign. So negative 0.75 is delta P. So precisely what exactly we are trying to do, we are trying to apply delta hedging process. For that we never needed put delta. Here the question wanted you to compute the delta, that is why put delta was computed more as a formality or more as a requirement to solve the question. But the real thing, the application part focuses on the call delta. So what happens? How did this concept of delta hedging emerge? So you have written a call option and you have taken a big risk. You want to hedge your position. Answer is simple. You have already sold a call. Now purchase some shares. How many shares? Delta shares. Delta in this case was 0.25. So you purchase 0.25 shares. Against sale of one call, if you are buying 0.25 share, that becomes a portfolio of shorting one call and longing 0.25 shares. So long 0.25 shares, short one call, that becomes your portfolio. That portfolio becomes risk free, because at the end of the period, whether the stock price rises to 200 or the stock price declines to 120, your portfolio will be having exactly same value. So your value of portfolio becomes risk free. If your portfolio becomes risk free, that can be considered as the base of the delta hedging. So let me show you what exactly I am trying to tell you over here, and this is something very, very important. You must note it down. So we construct a portfolio, we buy delta shares and sell one call. The portfolio value by end of the period, when we say that the price goes up, it will be VU, correct? Value of the portfolio when the price goes up, it will be delta into SU, because we don't have one share, we have delta shares. So delta into SU is the investment, and CU will be subtracted because that is the value of call. I'll be explaining to you this part once I take the facts and figures. And similarly, in case of downstate, the VD, that is a value of portfolio when the price moves down, it will be delta into SD minus CD. So a portfolio is risk free when its value is same in all possible future states. In other words, if VU and VD become same, the portfolio is considered to be hedged. So VU equals to VD is what we want to achieve. Now in our example, delta is 0.25, and what is the meaning of that? For every one call sold, we must buy 0.25 shares to eliminate uncertainty. So what will be the value of the portfolio if the price goes up? Now here you have to simply use your understanding, and here you have to be very, very careful. Let me explain this part to you with utmost prominence. VU is the value of your portfolio when the price moves up. When the price moves up, it goes to $200. The value of share that you have invested into is also moving up. So your investment value rises. But you don't have one full share, you have only 0.25 share. So what will be the value of your portfolio, VU? It will be basically delta into SU. Ask yourself again and again, how many shares you have? You have 0.25 shares. 0.25 shares multiplied by 0.25 shares multiplied by the value of stock at the end of the period when the price moves up, which is $200. So $200 is the value of one share. So value of 0.25 share will be 0.25 into 200. That will be what? That will be $50. And the value of call will be subtracted out of that. Why value of call will be subtracted out of that? Look at one thing. The value of call is positive. In other words, the call option at expiry becomes in the money, because the market price, which we are considering as SU, the expected market price is going to be 200, whereas the strike price of the call option was 180. So the call option is in the money and it will be exercised. Now look at one thing, you were never the holder of that call. You have written that call option. don't forget, in your portfolio you have sold one call, right? You have written one call option. So it is a counterparty who will be amazingly happy, because counterparty believes that it has made a gain of $20, and that counterparty will come to you and recover $20 from you. So from your portfolio, whatever asset value you have, this is your asset value, that is price of the share is going to be 200, but you have 0.25 share. So 0.25 into 200 will give you $50, but from that $20 will be taken away, because the call is in the money and you are the writer of the call. You will have to pay $20. So value of portfolio in your hand will be $30. Now we want this thing to establish, right? VU should be equal to VD. So if VU should be equal to VD, we must compute VD and check whether it is equal or not. So what is VD? It will be 0.25 into the price of the share when the price goes down, that is SD. So 0.25 into SD. SD will be 120. 120 into 0.25 will give you $30, correct? 120, 1/4 of that, 0.25 into 120 will give you $30. So this part will be $30, but if the price goes down, the call option goes out of the money and it will not be exercised. So the counterparty who is holding the call will never come to you to take away some money. In simple words, the value of call when the price goes down is 0. So nobody takes anything from you. So this is $30 minus 0, it remains $30. Look at this, your value of portfolio, whether the price moves up or the price moves down, either way your portfolio has a consistent value. That is why we say VU equals to VD, which makes your portfolio risk free. Let me give you a moment to take the screenshot and write down in case you want. Now what we have to further understand is something very, very vital again. See, VU equals to VD, your portfolio became risk free. Recollect one thing that you have learnt, law of one price. If the two different investments are giving the same result at the end, their present value should also be same. So value of your portfolio could be either VU or VD, but both values are actually the same. So you simply compute the present value of VU or VD, you will land up at V0. So VU or VD both have value of $30 by end of the period. Your discount rate is going to be the risk free rate. Why are we using risk free rate? Because your portfolio became risk free. If there is a risk free portfolio which has a future value of $30, its present value will be arrived at by discounting $30 to its present value using the risk free rate as the discounting rate. So what will be V0? What will be the present value of your portfolio? The V0 value or the present value of your portfolio will be the present value of $30. So simply I would say VU is the PV of VU or VD discounted at risk free rate. So V0 will be present value of $30. So 30 divided by 1.05, that gives you 28.5714. Now look at one thing, we have established this V0 equation at the beginning. How did we establish? What did we do in our portfolio construction? We have sold one call. When you sell a call, you create an obligation. So that call gives you an obligation, it is subtracted. Delta S0, you are purchasing shares at the S0 price, that is at the spot price at the beginning. That is your investment, correct? That is the money that you are investing to buy delta share. So delta S0 is your investment and C0 is your recovery. So whatever money you have invested in this stock by buying not the full stock but delta stock, whatever amount you have invested, you got some recovery by selling the call. So this indicates your cash outflow in making your portfolio investment. This is a cash inflow that reduces the burden of your investment. That means out of this much you have already recovered C0. Out of delta into S0, which is your outflow, you have recovered C0 by an inflow because you sold a call, the call premium you will receive. That difference is V0. That difference precisely is going to be the money that you will arrange by borrowings. Why? See boss, you are creating a portfolio. If you are creating a portfolio, you are buying shares and you are selling a call. You have to also borrow at the risk-free rate. Now use your simple common sense. Recall what is fiduciary call. If you can recall what is fiduciary call is a combination of risk-free investment and holding a call. So holding a call with risk-free investment becomes a fiduciary call. Take the reversal situation. Instead of holding a call, you have to sell the call, and the combination can be made in that same manner. So the whole fiduciary call, if you are taking the reverse position, instead of buying the call, you will sell the call, which you have done already in this case, and instead of investing at risk-free rate, you should borrow at the risk-free rate. How much you should borrow at the risk-free rate? That much which is the present value of exercise price. That is what we have learnt. Present value of exercise price becomes your borrowing. So this V0, which is borrowing, we have already computed this value, 28.5714. Now what you do? From this equation, if you want to find the value of C0, take C0 with a negative sign to the left hand side, it will become positive C0, and bring this V0 to the right hand side. So the equation goes this way, C0 equals to delta S0 minus V0. Now we have already computed V0 value and S0 is already reported to you. Delta you have computed, that is the call delta you have computed as 0.25. So you have 0.25 shares. Presently the share is priced as $160. So 0.25 into 160 is this term, and this is your value of portfolio at present. That means subtract V0, you will be getting the balancing figure as C0. This can also be the approach used for determining the value of call. So value of call will be 0.25 into 160 minus V0, that is 28.5714. When you do this calculation, what you get is exactly 40 minus 28.5714, that is 11.4286. That was the value of call option, correct? The C0 value which we got from binomial model was also this. Now this is the computation of the value of call using the portfolio replication, where we have applied the concept of delta hedging. Now if you understand this line, if I rewrite this line symbolically, you know what is this? Left hand side is C0. What was this 40? It was delta into S0, delta into S0 minus V0, correct? This 28.5714 was nothing but V0. This is the equation. Now if you have understood everything up to this part, from here we are actually going to make a transition to BSM. This is the point of transition. So everything I have discussed up to this part was just the application of binomial model, computing delta, computing the value of call and put. I did not introduce the put call parity. If you want, as a matter of check, we have computed the value of call and put both. You have all the information available. As an additional assignment for yourself, you can apply put call parity and check that parity will work. You will get both the sides matched, or in other words, you compute the value of put through the value of call using put call parity. It will match with whatever you have computed in the previous working as value of put through binomial model. So this will be the end of binomial model. From this point, I am going to take you to the transition into Black-Scholes-Merton model. From here, the logical step-by-step formula building is what you need to understand. So let me just give you a moment to take the screenshot and then we move ahead. So now talking about the transition from binomial model to BSM, that is Black-Scholes-Merton model, you have to understand certain fundamental things. If you can understand this part, your entire learning of BSM will become extremely comfortable. So what happened in a binomial model, if you recall, particularly in a single period binomial model, there is a share which is currently priced at $160. By end of the period, the price can either move up or move down, move up to 200 or move down to 120. That is what we have discussed. Now, this period in a single period binomial model, this period is considered substantial period, maybe 3 months or 6 months, one period. But if you observe one thing, in this period of say 6 months, the movement of 160 to 200 won't happen suddenly, it will happen gradually. That means someday the price will become 161, then 162, 163, gradually it will move on to 200. When I say gradually, for making that gradual thing, let us split this into 2 period first. So imagine that there is a price in between 160 and 200, that is say 180. So from 160, at end of one period, the price comes to 180 and then it goes to 200. From 180, it could decline back to 160 also, correct? So from that node of 180, there can be again an up move and down move. Likewise, when it is declining from 160 to 120, imagine that there is a node in between which is priced as 140. So from 160 to 140 and from 140 to 120. When it came to 140 in the middle node, from there the price can again rise. That means at every node there is a possibility of price moving up or price going down. So if I make this transformed into a 2 period, what will happen? Overall it is 6 months. When I say 2 period, it will be 3 months and 3 months. Point is, at what frequency in real life will the stock price move up or down? The answer is not 6 months, not 3 months, not even 1 month, not even 1 day. Within a day, multiple times this is going to move. So imagine that you keep constructing this tree for every moment of price change. By end of 6 months time, how big the tree will become. If you are taking the change in terms of time as infinitely very small time frame, every moment, say every second, the price is changing, then this up and down move, you have to construct it multiple times, and that will make a huge tree where calculation node by node will become almost impossible. That means what we were doing in 1 period and 2 period or even multi-period binomial model, that is not going to work. Secondly, when we constructed this delta value as 0.25, the call delta was 0.25, it was based on these price expectations, right? If that expectation keeps changing every moment, the delta value will never be constant. So if there is actually a call option expiring in 6 months time, multiple times the price will change, and therefore multiple times the delta will change. So your hedge position needs to be monitored and it needs to be changed every moment. In other words, it needs a continuous change. So what will happen? If the price changes continuously, delta will change continuously, and delta hedging, you'll have to change the hedge position continuously. Means once you have hedged, you cannot relax for 6 months time. You have to change every time the price changes, because the fact you should never forget, delta is a measure of how the call value changes with the changes of the price. And if the price expectations are changing every moment, delta value will change every moment. And that is where, when we speak of option Greeks, the effect of price change is factored by delta, effect of delta change is factored by gamma. So because of the impact of gamma, the delta is going to change every moment. So your hedging cannot be a one-time hedging. Hedging has to be continuous. So if we try to sum up from a single period to 2 period, from 2 period to multiple period, and then multiple period, like 6 months time, and the changes is occurring, the changes in price is occurring every moment. So there will be infinitely small time which will be considered at every moment. You will be having too many changes happening in these 6 months, which cannot be dealt with by discrete probabilities. There will be continuous probabilities. So we are shifting from discrete probability to continuous probability. That is where the continuous probability distribution, normal distribution, you will have to bring probabilities. Instead of taking the risk neutral probability of one period, you have to take the risk neutral probability which is based on the normal distribution. Why normal distribution? Because normal distribution indicates a continuous probability distribution. So when you computed delta by taking Cu minus Cd by Su minus Sd, it was a one period calculation. When the periods increase and the change happening continuously, your delta value will be altered with the continuous changes. That is where we are talking about the transition from binomial model to BSM model. So let me guide you on this part and explain this transition part gradually one by one. So in binomial, what we did in a single period binomial, we hedged for one period. In reality, we need to hedge continuously because prices are going to change continuously. So binomial is always a stepwise hedging, whereas BSM talks about continuous hedging. Binomial delta was fixed for two outcomes. The price will either move up or go down, whereas in real world the price keeps changing and the outcomes could be multiple, just not restricted to two outcomes. Delta must keep changing continuously. That continuously changing delta leads to what we call as n of d1 in BSM. So what we were using as the symbol delta in the binomial model, that transforms to n of d1 in BSM. That means the logic of delta still remains the same, but its value is now derived as n of d1. Now n of d1 is the continuous version of binomial hedge ratio. What we were calling as delta, let me just expand the screen size for you. What we were calling as delta, correct? Now it is the continuous version of that binomial hedge ratio, that was delta. So what we were using as delta in the binomial model, it will be now treated as n of d1 in Black-Scholes-Merton model. So once you take note of this, we will move ahead, and now we will say in binomial you found V0 as the bond component or risk-free borrowing part. That bond component we calculated in binomial becomes the borrowing in BSM. So if you remember your original equation was what? Under the binomial delta hedging, your original equation was C0 equals to delta into S0 minus V0. Look at this. How did we construct this equation? We have derived this equation from the equation of V0, because V0 was delta S0 minus C0. From that we derived C0 will be delta S0 minus V0. So this is the equation, and now what we will do in BSM, delta will change to n of d1. So in place of delta we are going to place n of d1. So it will be delta S0 minus bond term. V0 was the bond term which was risk-free borrowing. Why was it risk-free borrowing? Do you recollect? Let me remind you if you forgot. Look at one thing. S0 was the price of the share. You invested in the share, so you have made an investment, and whatever investment you have made in the share, that is not the entire share, that is the portion of the share that you have purchased, that was delta share. So delta into S0 became your investment. that investment was bigger than the money that you received on selling the call. So one call what you have sold or one call that you have shorted, that gave you C0 as a cash inflow, which was smaller than the delta S0 value. To bridge that gap, we have made some borrowings at risk-free rate, that was V0. So that bond term which you are kind of issuing bonds at risk-free rate, in other words you are borrowing at risk-free rate. Issuing bond at risk-free rate and borrowing at risk-free rate are one and the same. So you are borrowing at risk-free rate. So bond term will be how much you should borrow at the risk-free rate is basically the present value of exercise price. So bond term will be the present value of exercise price into n of d2. Now from where did this n of d2 come into picture? So we are saying n of d1. So look at what we did. We have taken the replacement of delta with n of d1. So in the equation C0 equals to delta into S0. In place of this delta, we are taking n of d1. So n of d1 into S0 minus V0. V0 was the bond term which we are taking as present value of exercise price multiplied by this n of d2. Why are we multiplying this n of d2? That logic we have yet to discuss. So here this line is going to be very, very important. We do not borrow full strike price. So basically the strike price or exercise price, the present value of exercise price was something that you could have borrowed, but you will borrow that not the whole amount but only to the proportion required. That proportion is n of d2. So we do not borrow full strike price because payment is not certain. We borrow only relevant portion. BSM is nothing but binomial model where we move from two outcomes to infinite outcomes and hedge continuously instead of once. Let me expand the screen size for your reference so that you can take note of all of these points carefully. This noting down is important. I must emphasize that you should write down each and every term from here. So once you have noted this whole thing, we move ahead and now we say in binomial we hedge a call by buying delta shares and shorting the call for one period. In BSM the same idea survives, but now hedge adjustment happens continuously. Therefore binomial delta becomes n of d1, that is the continuous time delta, and borrowing component becomes x into e raised to minus rt. This is nothing but the continuously compounded risk-free factor, correct? When you borrow at risk-free rate, to find the present value of exercise price, you will take x into e raised to negative rt. You know this is the present value factor for continuous compounding, and that present value factor when multiplied to x, this term you will be getting the present value of exercise price, and that will be multiplied to n of d2. So this is the discounted strike term. N of d2 represents the weight applied to the present value of strike price in the replicating portfolio. So it determines how much of the strike obligation is relevant today. So I believe you are observing one thing carefully, that how gradually one by one we are taking the same base equation from the binomial model, that is from the single period binomial model, and we are making the required modification to arrive at the BSM equation. The BSM equation also targets to find the value of C0, but to find the value of C0 we are taking the first term as it is, that is delta into S0. Instead of delta it is n of d1. So the first term becomes n of d1 into S0 minus, it was V0. What is V0? V0 is the risk-free borrowing. What you need to borrow? The present value of strike price. So present value of strike price is exactly this term, x into e raised to minus rt. But you are not going to borrow the whole thing, you are going to borrow a portion of that. So that portion is the probability indicator which we are identifying as n of d2. See, mathematically D1 and D2 can be derived as per BSM. At level 2, the computation of n of D1 and n of D2 is not being asked. Computation is not asked. Let me tell you one thing very clearly. At level 2, they will give you n of D1 value and n of D2 value. You just have to apply that. However, in other exams, like what we deal with CA and CMA exams in India, they will test on even computing D1 and D2. So there is a mathematical approach within BSM to compute D1 and D2. Then within D1 D2 calculation, once you arrive at D1 D2 calculation, what you will find is D1 D2 can be mathematically determined, and then the computed value of D1 D2 will actually be a Z score which you will apply on the normal distribution and arrive at the respective probabilities, that is n of D1 and n of D2. So what happens? The next follow-up discussion after this transition part, I am going to give you one example on the whole calculation. I am repeatedly telling you it will not be tested at level 2. But what happens? In your core material, they have given that formula. So what happens if you don't touch that? Unnecessarily you will be feeling that stress that you have not done this, you have not done this. Just to make you relieved from stress, as a matter of calculation, it's a mathematical formula. It is derived with core mathematical application. That derivation is literally beyond your understanding. But as a matter of feeling the application of that calculation, we are going to deal with at least one example situation to deal with that. So as a part of a follow-up to this particular discussion, I am definitely going to introduce one such variety where you get the complete understanding of BSM calculation based. So as of now, what we do, we make sure that this note you have written very clearly, and once you have written this, we will move ahead and we conclude that n of D2 can be interpreted as the risk neutral probability that the option will expire in the money. Now n of D1 was something that relates to stock sensitivity today. N of D2 relates to probability of paying the strike price at maturity. So n of D1 adjusted for today's hedge requirements, that is why n of D1 is actually the hedge ratio, and n of D2 is the adjustment for future uncertainty, that is the volatility effect. So look at the transformation to the BSM equation. You look at this, here we are taking the BSM equation as C0, the value of call option today, as n of D1, which was delta, into S0 minus the present value of strike price. So present value of strike price is getting multiplied to n of D2. So this is something that you have to write as a matter of your last part of this transition, and then we will start attempting questions on BSM.